All right, let's get into the markets now. Asian stocks fell in today's session with the Japanese Nikkei registering the biggest drop on the day. Market players are all waiting for the latest US CPI number, with all eyes mainly focused on what the Fed will decide on interest rates next week. The Nikkei share average declined by 1.5%. The Hang Seng Index closed down 0.73%, while the Shanghai Composite Index ended 0.82% in the red. US markets ended their session mixed. Financial and energy stocks served as a drag on the day, with the likes of JP Morgan down over 5%, Goldman Sachs down nearly 4%. ExxonMobil and Chevron were also hit on the back of concerns around the lower oil price. However, tech counters as well as real estate and discretionary consumer stocks, among others, performed better. The Dow Jones Industrial Average declined by 0.23%. The S&P 500 rose by 0.45%, while the Nasdaq Composite Index ended the session up 0.84%. Currently, the JSE's all-share index is trading weaker. It's slipping by about 0.5% at 81,209 points. The rand's trading higher as improving domestic backdrop insulates it from some external pressure. The local unit is at 17.85 against the US dollar, 23.35 against the British pound, and 19.72 vis-a-vis the euro. Gold is trading at $2,522 an ounce, while platinum is trading at $941 an ounce, and Brent crude oil is at $70.55 a barrel. All right, Patrick Matidi from Aluwani Capital Partners joins me now. Thank you very much, Patrick, for joining us. So yesterday was the big debate between Kamala Harris and Donald Trump. Did it tease out any important policy issues for the market to consider, do you think? And what else is driving the markets today?
Yeah, good afternoon, and thanks for having me. I think the markets are always focused more on the trade policies in terms of what each candidate is likely to bring. There wasn't a lot of that in yesterday's debate, unfortunately. But what we do now is that, Trump stands for, let's say a trade, sort of a tariff sort of regime, which is likely to be inflationary to the U.S. economy, as U.S. companies actually bring home onshoring some of their operations from other jurisdictions to try and prop up the local economy. I think Harris was a lot more accommodating in terms of that trade stance, but I guess we'll have to see, once either candidate is in office, as to what policies are actually rolled out and the impact that will have on the markets going forward.
So in terms of course, expectations around the globe, everyone is waiting for that US CPI number. It's something we've been talking about for the whole week, but you can speak to that as well.
Yeah, so later this afternoon, we should get the August CPI number from the U.S. The markets are expecting around 2.4% versus 2.6%, which was the last number that came out. I think this number is fairly crucial because, it's coming ahead of the Fed's meeting in September. I think that it's next week. We did see a few days ago, the jobs market continuing to weaken quite substantially. So the big debate now is whether the Fed will cut by 50 versus 25 basis points, and also that being underpinned by the rate of deterioration in the underlying economy. So I think the market will therefore wait to see what that number looks like. If it comes worse than expected, I think we can expect, bets to be piled in with the further rate cuts to be expected from the Fed.
So the Bank of Japan has signaled to the market that it's still on track to raise interest rates if the inflation picture demands it. But if you recall, last month or so, a couple of months ago, when they made a similar signal, there was a massive sell-off on the Japanese markets. And even today, relative to other Asian markets, the Japanese markets were the ones that were hit the hardest. That's a kind of tricky situation. And of course, a central bank shouldn't be held to ransom by market players, but what are your thoughts there?
Yeah, so Japan has got a different problem altogether compared to the rest of the world in that their biggest challenge has been deflation. So they've been struggling to actually get prices higher, which is why for the longest of times, they've had this almost a zero, if not negative interest rate environment where the official rates are actually lower than inflation. So that has then prompted a lot of the market players to use the yen as a funding currency, meaning that you go and borrow in yen, which comes with a zero interest rates, and then you use those proceeds to get invest in other jurisdictions where you get a bit of a yield. So what we saw a few weeks ago when they started hiking rates was that flow back of that money, where suddenly the cost of borrowing in Japan was going higher, and therefore you have to then unwind some of those investments and hence the sell-off that we've seen in other markets as a result of that move. So thankfully this time around, that has been flagged quite early on. So the market should be familiar with that stance from the regulators in the form of higher rates going forward. And so the impact, as and when it plays out, hopefully is a lot more minimal compared to what we saw a few weeks ago.
Yeah. So one of the reports we were making is that, part of the reason that markets fell yesterday in the United States was because of energy counters. They were down, but of course, the oil price has ticked up again now with the Brent crude oil price now over the $70 a barrel mark. Positive maybe, but apparently this is on concerns of hurricanes in the Gulf of Mexico where a lot of oil is produced. But ultimately, what are the fundamentals of the oil market right now?
Look, it comes down to supply and demand. So irrespective of what we're seeing, from the weather patterns point of view, demand for oil continues to be on a structural decline. And it is a bit worse now of late, with fears of recession. So we've seen the big two oil demanders, that is the US and China. China has been on a slowdown and question marks with regards to the US. And those projections, unfortunately, play against, the demand for oil, as in demand is weakening because of lower economic activity. On the other hand, on the supply side, we've seen the likes of OPEC, where amongst the membership, there has been this pressure to try and produce more because some of the countries actually need a lot more currency, to come from the sales of oil. And so you have this imbalance between supply and demand, where there's just so much supply coming through with the world not being able to absorb all of the demand, and hence an environment of weaker oil prices that we've seen pretty much for the last 18 months. So we think those factors will continue to be at play. Yes, there will be other factors in the interim, like the weather patterns, but we think on a structural basis, unfortunately, the demand for oil is actually on the way down.
So one last question, Patrick. I see that Anglo-American sold close to 14 million Anglo Platinum shares, for which they accrued about 7.2 billion rand. That's the equivalent of $400 million. Is this a signal that Anglo-American is ready to start divesting of its Anglo Platinum interest going forward? Because, of course, that was the whole debate when there was talk of Anglo-American being taken over.
Absolutely. So this comes as no surprise. As you rightly point out, earlier in the year, there was that failed bid by BHP for Anglos. And in response, Anglos came back with their own plans to restructure their own operations. And on the chopping block, was Amplats, which they didn't feel it fitted well with their plans, and then also the BS on the diamond side. So this is the first step in terms of divesting out of Amplats, where they're trying to create some liquidity, but ultimately, their plan is to exit completely Anglo-Plats and then focus on the rest of the portfolio where they think there is value to be had going forward.
All right. Thank you so much for your time and insights, Patrick. That was Patrick Matidi. He's from Aluwani Capital Partners.